Factories are going dark. Energy bills soar beyond what most families can pay. Political leaders offer only fragile reassurances. But amidst this chaos, China, the world's second-largest economy, remains silent, refusing to rescue Europe in its hour of need. China's reluctance is calculated, driven by shifting priorities, mutual distrust, and internal pressures. Europe, once a vital partner for Beijing, is now perceived as an unreliable ally, a continent caught in geopolitical turmoil, tethered to US-led alliances. Europe's systemic rival label for China in 2022 marked a turning point. The EU's scrutiny of Chinese tech giants like Huawei and its restrictions on Chinese investments in critical sectors strained the relationship further. As Dr. Yan Xuetong, Dean of the Institute of International Relations at Tsinghua University, states, China's priority is no longer Europe. Its resources are directed toward regions where resistance to its influence is weaker. Domestically, China's economy demands inward focus. Property market turmoil, with real estate giants like Evergrande teetering on collapse, and its own energy challenges have left Beijing with little room for foreign entanglements. Meanwhile, trade tensions with Europe persist, especially around environmental tariffs and tech regulation. Please like and subscribe. Leave your thoughts in the comments. Your support helps us grow. Thank you. Europe's woes stem from a convergence of crises. The energy shock from the Russia-Ukraine war exposed the fragility of its energy infrastructure. Previously reliant on Russia for 40% of its gas supply, Europe now faces LNG prices nearly triple those of pipeline gas. Debt, too, is a silent but pervasive enemy. During the COVID-19 pandemic, European governments spent over 2 trillion euros on stimulus packages, pushing public debt in countries like Italy and Spain to unsustainable levels. Italy's debt-to-GDP ratio now stands at 135%, one of the highest in the world. Demographics exacerbate the situation. With declining birth rates and an aging workforce, Europe struggles to maintain productivity. According to the European Commission, the working-age population in the EU is projected to shrink by 2% by 2030, leaving economies like Germany and Italy grappling with labor shortages. Internally, political fragmentation weakens Europe's ability to respond cohesively. Member states clash over energy policies, fiscal priorities, and migration, issues that demand unity but reveal division. As former European Commission President Jean-Claude Juncker said in 2023, Europe is no longer setting the global agenda. It's reacting to crises it failed to anticipate. Energy dependency has turned Europe into an economic hostage. The abrupt cutoff of Russian gas forced Europe to import liquefied natural gas, LNG, from the United States and Qatar at exorbitant prices. In 2023, European gas prices averaged 150 euros per megawatt hour, 5 times pre-crisis levels. Industries reliant on cheap energy are folding under the pressure. Germany's chemical sector, which employs over 500,000 people, has seen production fall by 10% year-on-year. BASF, Europe's largest chemical producer, announced plans to scale down operations in Germany, citing unsustainable energy costs. Households face parallel struggles. In Spain, energy poverty, defined as spending over 10% of income on energy, affects 17% of families, according to the Spanish National Statistics Institute. Governments have introduced subsidies, but these are temporary fixes to a long-term problem. The broader impact is inflationary. As energy costs feed into transportation, manufacturing, and agriculture, prices for everyday goods remain high. Eurostat reports inflation in the Eurozone at 7.5% as of late 2023, with no clear path to normalization. The answer lies in Europe's ability to adapt, and quickly. Diversification is underway. LNG imports are up 60%, and renewable energy production is growing. Denmark and Germany have expanded wind power significantly, with Germany producing over 27% of its electricity from wind in 2023. However, infrastructure bottlenecks persist. Many EU nations lack the capacity to store or distribute LNG efficiently, leaving countries like Hungary and Slovakia heavily exposed to supply disruptions. Nuclear energy offers a potential solution, but political opposition, particularly in Germany, has slowed progress. The International Energy Agency estimates that achieving full energy independence from Russia could take another decade. In the interim, Europe faces hard choices: rationing energy, subsidizing costs, or risking further industrial decline. Without affordable solutions, Europe's recovery remains fragile. Germany, long seen as Europe's anchor, now finds itself adrift. High energy costs have eroded its competitive edge, particularly in manufacturing. Exports, the lifeblood of Germany's economy, have declined by 8% in 2023 alone, driven by reduced demand from China and the US. The automotive sector, a German stronghold, is under siege. Volkswagen and BMW face growing competition from Chinese electric vehicle makers like BYD, whose lower costs and faster innovation cycles are capturing global market share. Meanwhile, supply chain disruptions have compounded delays and inflated production costs. Domestically, inflation and rising interest rates weigh on households. A middle-class family in Berlin now spends 30% more on utilities compared to pre-2022 levels. According to the Bundesbank, economic contraction is expected to continue into 2024, threatening social stability. Across Europe, the energy crisis is hollowing out industries. Steel plants in Italy, paper mills in France, and chemical factories in Belgium have cut production or shuttered entirely. In Italy, steel production dropped 18% in 2023, according to the Italian Steel Association, with 15,000 workers facing layoffs. The human toll is equally devastating. In the UK, 6.7 million households, over 25% of the population, live in energy poverty. Food banks report record demand as families prioritize heating over groceries. The Financial Times recently called this the Great Energy Divide, a crisis that disproportionately affects low-income communities. Governments have tried to cushion the blow with subsidies, but these measures are costly. The EU has spent over 600 billion euros on energy relief since 2022, money that could have funded long-term energy solutions. As subsidies run out, the question remains: who will shoulder the cost of Europe's survival? The European Central Bank, or ECB, has raised interest rates aggressively to combat inflation, yet this policy is a double-edged sword. While higher rates have tempered inflation, they've also increased borrowing costs for businesses and households. For heavily indebted nations like Greece and Italy, rising interest payments threaten fiscal stability. Italy's debt servicing costs rose by 15% in 2023, pushing the country closer to a potential debt crisis. Meanwhile, small businesses across Europe report reduced access to credit, stifling growth and innovation. ECB President Christine Lagarde defends the policy, arguing inflation remains the greater threat to economic stability. Critics, however, contend that without structural reforms, such as addressing energy dependency and improving productivity, these monetary measures merely postpone the inevitable reckoning. China's reduced engagement with Europe is accelerating the continent's decline. In 2023, EU-China trade fell by 14%, with European exports of machinery and vehicles seeing the sharpest declines. Simultaneously, Chinese foreign direct investment, or FDI, in Europe dropped to 7 billion euros, a 40% reduction from its 2019 peak, according to the Rhodium Group. Beijing is redirecting its focus toward the global south, strengthening economic ties with Africa, Latin America, and Southeast Asia. These regions offer fewer regulatory hurdles and higher growth potential, leaving Europe sidelined. Europe's industrial competitiveness has been eroded by high energy costs, regulatory burdens, and slow innovation. In the EV market, Chinese automakers now dominate, producing vehicles at a fraction of the cost of European counterparts. Meanwhile, the U.S. Inflation Reduction Act has lured European manufacturers stateside with generous subsidies. To remain competitive, Europe must accelerate its green transition and invest heavily in research and development. However, without cohesive industrial policies, the gap between Europe and its rivals continues to widen. Debt is Europe's Achilles heel. Total public debt in the Eurozone exceeds 12 trillion euros, with France, Spain, and Italy accounting for nearly half. Rising interest rates have compounded this burden, leaving governments with fewer resources to invest in recovery. Subsidies for energy relief alone have cost the EU over 700 billion euros since 2022. As debt servicing costs rise, austerity measures loom, measures that risk exacerbating social unrest and economic stagnation. Reversing deindustrialization requires bold policy action. Europe must prioritize investments in automation, clean energy, and advanced manufacturing. Incentives for reshoring industries could revitalize local economies, while streamlining regulations would attract foreign investment. However, these efforts demand unity among EU member states, a challenging prospect given political fragmentation. Without coordinated action, Europe risks becoming a service-based economy, dependent on external powers for its industrial needs. Europe's importance to the global economy cannot be overstated. It accounts for nearly 15% of global GDP and remains a key trading partner for nations worldwide. A prolonged European downturn would disrupt supply chains, weaken global demand, and create financial instability. For example, China relies on Europe for high-end machinery, while African and Latin American countries depend on European markets for agricultural exports. A European collapse would send shockwaves through these interdependent economies. To secure its future, Europe must invest in renewable energy, expand wind, solar, and nuclear power to reduce dependency on imports, foster innovation, increase R&D funding to maintain competitiveness in tech and manufacturing, unify policies, streamline regulations and foster greater economic cohesion across member states, address demographics, encourage immigration and family-friendly policies to replenish the workforce, balance debt, implement sustainable fiscal policies that allow for growth without excessive austerity. These measures require political will and long-term commitment, but are essential for Europe's recovery. Is this Europe's Great Depression moment, and what does it mean for the world? Europe's current crisis is its most severe since World War II. While not yet a Great Depression, the parallels are striking: mass unemployment, social unrest, and diminished global influence. For the world, Europe's struggles are a stark reminder of the fragility of interdependence. The decisions made today will shape not just Europe's fate, but the trajectory of globalization itself. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.